Australia is a property economy. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. I thought we'd look at this article from the ABC. How the RBA allowed Australia to become a servant to property prices in a $9 trillion market. Now, here's the thing. I'm going to bring up the Observatory of Economic Complexity. You can see Australia's score here. We're, 0.19 negative. So we're ranked 79th out of 146 countries in the world. That's not the worst ranking. If we bring up, hang on, I'm going to find the Harvard assessment guys. They've got us ranked even worse. The Harvard Atlas have us at 86th in the world. So our economic complexity is falling, everyone. That's to do with the complexity of our exports. And, part of that is because we can get cheaper imports from overseas, less onerous government conditions, cheaper energy, and, less needy and demanding labor. So that's why, everyone. We're not competitive in many of these sectors. All these people are calling for increased manufacturing in Australia. But you've got to remember, to start up a business, you've got to jump through one hoop after another hoop. Then you've got the people who don't want you to build anything anywhere. Then you've got the jealousy that everyone has, so they want to chip away at your ability to run a business. Welcome to Australia. No wonder everyone just goes stuff it and would rather sit in property. So let's have a look what Ian has to write here. Size, it seems, really does matter. A decade ago, when Main Street was forced to bail out Wall Street and taxpayers around the world stumped up trillions of dollars to save commercial banks and the entire capitalist system, it was all the justification that was required. The banks, they say, were too big to fail. Once again, it's become the phrase du jour. A few weeks back, it was China Evergrande, the hopelessly indebted Chinese property developer that is dragging its competitors in the Middle Kingdom's property market into the mire, is turning into a problem without a solution. Most reckon Beijing will be forced to ride to the rescue in some form, as a total collapse could be catastrophic. Well, we'll have to see, everyone. We'll have to see. Beijing are the one that instigated this whole situation with the three red lines, with their limitations on the amount of debt that these businesses can have. So, here's another one to add to the list, our very own residential property market. Admittedly, we're not alone. Almost every developed and many developing economies have seen housing and land prices soar in the past 2 years from already elevated levels. The reason is pretty obvious. Interest rates are at their lowest level in 5,000 years. These claims are pointless. 5,000 years. We're talking completely different monetary, economic, and political system. I know people love to make those claims, particularly the precious metal, real money crowd, but come on. And households have borrowed like there's no tomorrow just to get a foothold in the market. But tomorrow has arrived early. With inflation rising here and around the world, money markets have gone berserk. They've pushed interest rates, particularly short and medium-term rates, much higher. That's in anticipation of central banks, particularly ours, being forced to raise rates much sooner than anticipated to clamp down on the rapidly increasing cost of living. But the desk jockeys are forgetting one very important thing. Central banks may no longer have the capacity to raise interest rates anywhere near the levels required to slow an inflationary spike. Doing so could send a large number of households, many of which are leveraged to the eyeballs with loans under 2%, to the wall, and that would cause the economy to tank. Having created the biggest real estate bubble in history, our very own Reserve Bank now has its hands tied. Property is now too big to fail. Well, we've got to see, guys. There are a lot of people that have made significant prepayments in their mortgages. Their households, which have liquidity buffers. The banks have factored in. They've factored in buffers of 3 to 5% in mortgages, guys. So, they can. Even the RBA just talking about rate rises is going to make an impact on the psychology of the people. What would happen if you start to see it just tick up once or twice? Fear will sit in. And that will have a bigger impact than the rate rises probably will anyway. We'll have to see. So I don't know if you can hope for a calamitous crash in property to get in. The problem at a glance. Just to set the scene, here are a couple of eye-watering statistics. Australians now own $9 trillion worth of real estate, and the nation has whacked on an extra $1 trillion in just the past 5 months. We owe around $2 trillion to our banks, and our banks are hugely geared to property with around 60% of their total loans in residential real estate. As for household debt, we are world beaters, regularly vying for the top spot. As you probably guessed, most of the debt is tied up in housing. As in this graph from the Reserve Bank shows, soaring real estate prices are the culprit. It's a neat little merry-go-round, or as many have put it, a feedback loop. Nationally, the average housing loan has jumped to $565,000, 3 times bigger than in 2002. At first glance, $9 trillion in debt over $9 trillion in valuation looks pretty safe. But the debt is skewed to relatively new property entrants, younger Australians who are crucial to keeping the economy going. They're the ones deep in debt, and the speed and level of borrowing in the past 18 months has been something to behold. I mean, yeah, we've seen that. People have been getting into property. I wonder how many people who got in, are now in a significantly more improved equity position because of the recent jump in property. Here's the thing with housing, it's not like other investments. It's not like stocks. It's not like crypto. It's something that people will fight. It's not even like commercial property. It's something people will fight tooth and nail to hold on to. The inflation boogeyman comes back to bite. Most people mistakenly believe the Reserve Bank sets interest rates. It doesn't. Rates are set in the commercial market where money changes hands at a price. The RBA is the biggest individual player in the market by a long way, and its decisions quickly filter through to prices. That's when things work normally. Right now, they're not. Last Friday, after a higher-than-expected inflation spurt in the September quarter, money markets went to war with the RBA, steamrolling its efforts to keep interest rates at a whisker above zero. In retaliation, the Reserve Bank did nothing, and we'll have to see what their statement comes out today. That sparked talk that the RBA would raise the white flag while it sits down tomorrow in Sydney's, which is today, in Marketplace for its November meeting. That it will abandon its post-pandemic efforts to muscle short-term interest rates to the floor. RBA Governor Philip Lowe has been adamant. Official rates would remain at 0.1% until 2024 at the earliest, and the bank has been in the market buying up government debt on the open market to keep a lid on market rates. After last week's inflationary numbers, which leapt to the backing of surging fuel prices, market traders convinced themselves the RBA simply can't wait another 3 years before taking action, and pushed rates on short-term debt to 0.7%, almost 8 times higher than the official rate. These markets are where our banks borrow money. Should this go unchecked, it will quickly feed through into new mortgage pricing and could see the end of ultra-cheap variable home loan rates. Super cheap fixed-rate deals are now becoming scarce. Yeah, I mean, come on. Money's still bloody cheap. Even if we look here, let's bring up this one here, guys. Let's bring up here. Look at the cash rate. Okay, 3% was considered an emergency level. Even if they increase rates by a few percentage points, it's going to have an impact on some people. But remember, the banks have planned for this. We're not talking crazy times in the past. They're not as irresponsible as lending as many people lead you to believe. They're doing that to get political control and to taper what freedom the banks actually have. These people want control, everyone. That's what they want, under the guise of property affordability and your safety and security for your financial Sicherheit. So, real estate is the single biggest asset for a huge portion of Australian households. When prices are rising, we feel wealthy and spend more. Yep, the wealth effect. When they're in decline, the reverse psychology kicks in. People spend less and construction slows, creating a huge handbrake on the economy. When real estate slumps, that's when problems really become acute. As the single biggest earner for our banking system, property is also its Achilles heel. A significant downturn lifts bad debts, immediately tortures earnings, and undermines the value of the biggest portion of its debt portfolio. But we've seen the government intervene again and again to keep that sector going. We're not China. Our government isn't going to step away from property. The scenario poses a significant risk to our financial system. For that reason, central banks and governments need to keep housing markets buoyant. You only have to look back at the GFC a decade ago to see the horrendous impact created by a property bubble burst. Well, yes, but the banks in Australia are in a much better position than they were in the GFC. And what happened in the GFC in Australia? Yeah. Having stood on the sidelines while house prices went to the moon, No one can now afford to let it return to earth because the system relies upon constant price increases. If inflation really does take a grip, instead of the transitionary bounce-back effect from last year's recession, the RBA and many of its counterparts will find themselves caught on the edge of a cliff. Little room to move with the prospect of a catastrophe at the slightest misstep. If they can't raise rates to slow down inflation, the onus will fall to government to slash spending. This is never popular with voters. Declining house prices aren't either, and given there are far more voters who own homes than those who dream of owning one, guess which side the government will likely favour. That's why, with our leaders talking about affordable housing, they're talking through their backsides. Well, yeah, I think I can agree with Ian right there. It's all bullshit, the talk of housing affordability, particularly from the political class, guys. Here in Australia, property is king. It is part of our culture. It's ingrained in our entire nation now. You go to barbecues, people talk about property. It's on TV shows. It's like a sport. I can't see it correcting at all, everyone. We'll have to see, guys. I think we'll have more government intervention than anything else. Anyway, I'd like you to check out this video I just did on the Realpolitik channel that I've got discussing business and company directors needing to get a digital ID to address phoenixing. I think a lot of people would actually support it. Take care, guys, and I'll see you next time. Bye for now.